بسم الله الرحمن الرحيم. أبنائي الأعزاء، النهارده إن شاء الله ناخد الدرس الخاص بالكوست اوف كابيتال. Cost of capital means تكلفة الأموال. As you may remember, last lecture we have the initial investment equal 170 and we have a cash flow equal 10, 25, 25, 380. And to calculate the net present value, you have to calculate the present value of the cash flow and deduct the initial investment to get the net present value. To calculate the PV of the cash flow, you have to have the WACC. Remember? Weighted average cost of capital, which means a discount rate. And it was given on the example, it was 15%. Today, all what you need to know, how can we calculate the discount rate, which is, we can call it cost of capital. Okay. To calculate the cost of capital, because the initial is not a long-term investment, so it has to be financed from long-term sources. And the long-term sources is common stocks, preferred stocks, and long-term debt, which is bond. This is the only three long-term sources we have. So, today, inshallah, we need to know how can we calculate this percentage, which is, we can call it discount rate, we can call it WACC, which is weighted average cost of capital, and we can call it only cost of capital, and sometimes we can call it required rate of return. What does it mean? It means to get the amount 170 million. It costs you how much? This is what we mean. Okay. So the example we have today, that this is the example that we have an initial investment equal 600,000. And we decide, and this initial investment, which is 600,000, it will generate a profit. It will generate a cash flow. We'll say it before, we'll say it later, 175,000 each year for 5 years. And as a company, we decide to get this amount of money, 300,000 from the common stocks, 100,000 from preferred stocks, 200,000 from bond. So, first, we need to know if we will get this value of money, 600,000, from these sources. It costs us how much? To calculate the cost of capital, you have to have this table. This is the sources, common stocks, preferred stocks, bond, and this is the value we will get from each item. And this is the weight. What does it mean, weight? Okay. Common stocks 300 divided by the total amount, which is 600, it represents 50%. Preferred stocks 100 divided by 600, 16.7%. 200,000 divided by 600, it is 33.3%. The total weight is 100%, which is 1. Okay. Now, this is the most important column. How can we calculate the cost of common stocks? To calculate the cost of common stocks, we have two approaches. The first approach, we call it CAPM. CAPM, which is capital assets pricing model. And the another approach, we call it dividends model. So we have two approaches. We can use it to calculate the cost of common stocks. Which one we have to use? This is depend on the information you have on the exam. Here he give us what? He said, if you have the beta equal 1.5, risk-free rate 7%, all of those means that we have the CAP-M model. CAP-M model, we can use it to calculate the cost of common stocks. CAP-M, so now this is the cost of equity, the cost of common stocks. I know that I said cost, but I write return. Why I do this? It's okay, it's the same. You can write CE or RE. CE, cost of equity, this is from the company point of view. Because the company is going to give a dividends to the shareholder, it is a cost. But from the investor or shareholder point of view, we represent this for them view, it represents a return. So you can say cost of equity, this is from company point of view, or return of equity from the shareholder point of view. So the return of equity or cost of equity equal RF, which means if there is no risk at all, the common stockholder, we can give them only the risk-free rate, which is the return of the treasury bills. But if it has risk, we have to give them extra return, a premium. How can we calculate this one? It is depend on how much risk you have. The risk will be measured by beta. Inshallah later we will explain how can we calculate the beta of the company or of the project. This is multiplied by the return of the market minus the treasury bills rate of return. Okay. This is the equation we have to use to calculate the cost of common stocks. RM minus RF, sometimes we call it risk premium. Risk premium. Okay, so according to our example, the cost of equity equal RF, he said it's 7% plus, beta, he said 1.5, multiplied by, instead, he said RM minus RF, he said risk premium equal 8%. This is exactly same if he said RM equal 15% minus RF equal 7%. Okay. To calculate this value, 1.5 multiplied 8%, it's 12%, plus 7%. So now this is equal 19%. So if I go to the table to calculate the risk, the WACC, so cost of common stocks is how much? 19% according to this equation. If we have another approach, which is dividends approach, the equation is that the cost of equity equal D1, D1 means future dividends, divided by the current stock price, all plus by the gross rate. D1 equal what? D1 equal, as I said, future dividends. So you can get D1 equal the current dividends, which is D naught or D0, multiplied by 1 plus G. G, which is the gross rate. G, how can we get G? G equal ROE, remember ROE, return on equity, multiply by 1 minus dividends rate. You can say dividends rate or you can say retention ratio. Remember retention ratio نسبة الأرباح المحجوزة. So if the dividends ratio 40%, so 1 minus 40% represents 60%. This 60% represent the retention ratio أو الأرباح المحجوزة. So by calculating G, D naught multiplied by 1 plus G give you D1, and you can calculate this one. D1 divided by the stock price equal G. Okay. Now we need to calculate the cost of preferred stocks. Cost of preferred stocks, to understand the equation, cost of preferred stocks, it is exactly the same concept. As you may remember, this is the preferred stock. This is the face value, and this is the dividends we will give it to the preferred stock holder. And as you may know, there is no maturity because this is the owner. Okay. You have to recognize that there is no gross in this one, which means even if we have a very high profit, we will not increase this one. It will remain the same, just 14%, which there is no gross. Or if there is no gross, it means we will not have a G. So the equation will be D1 divided by P naught. And because there is no gross in dividends, which means in this case that D0, D naught equal D1. So in this case, it will be RP, which is the return of preferred stocks, divided by D only, without 1 or 0, because all these equal, divided by P naught. Exactly like this one. So this is the equation for the cost of preferred stocks. RP equal D divided by P naught. According to our example, he said that preferred stocks dividend is $8, and the market value of preferred stocks equal to how much? 50. So the cost of preferred stock, it will be, this is the RB equal D divided by P naught, which equal 8 divided by 50. This is 16%. So I have to go to my table, this one, and I have to put here in front of preferred stocks that the cost of preferred stocks equal 16%. Finally, the cost of long-term debt or the bond. Okay. The long-term just to remind yourself, this is the shape of the bond. This is 1,000, which is the face value. And sometimes we put here the coupon rate, and the maturity is 10 years. Okay. You have to recognize what? You have to recognize that in this case, if the company issue a bond, you will receive annually interest equal to 12% multiplied by 1,000. This is 120, 120, 120. For how long? For 10 years, 120. And by the end, you will receive the amount which equal 1,000. Okay. If the company sell the bond at the beginning with a value equal 1,000, so in this case, we can call that the yield to maturity. Yield to maturity by Arabic العائد حتى تاريخ الاستحقاق. If the company sell the bond at the beginning with a value equal 1,000 and the investor will receive 1,000, so the YTM equal this value. Okay. But if the company success to sell the bond with a premium with a value equal 1,100, in this case, the yield to maturity, it will be lower than 12%. But if the company sell the bond with a discount, which is 900, it means that the investor who will pay today 900, but who will receive 120, and at the end he will receive 1,000. For sure, in this case, he generate a yield to maturity higher than this one. So, if we sell by 900, which is the discount, in this case, the yield to maturity will be higher than this one. How can we calculate exactly the value of the yield to maturity? Inshallah, will be remain with the subject of investment, not the corporate finance, but it has the same idea as, remember, IRR, internal rate of return. So, for the exam purpose, you will have the yield to maturity given, which is the cost of bond before stocks. And this value already contains whatever he is sold by premium or by discount or by the same value. He sold by issuing cost, تكلفة إصدار or not. So in this case, this will be given. In this case, the cost of bond after tax equal the cost of bond before tax multiply 1 minus the tax rate. In our example, he said that the cost of bond before tax, or sometimes we can call it yield to maturity, he said it was 20%, and the tax rate, it was 40%, so 20% multiply 60%, it is 12%. So in this case, we have to put in front of the bond that the cost of bond after tax is how much? 12%. Now, to get the value, which is the initial investment equal 600, you will get half of the amount from common stocks, 1/6 from the amount from preferred stocks, third of the amount from bond. Okay, and each one of those costs you a different amount. So on average, what is the cost of capital? Okay, the cost of capital 19 plus 16 plus 12 divided by 3? No, it is not right. This is only right if it was equally weighted. But because we have different weight, again, this is 50%, so this is percentage also 16.7%, and this percentage also 33.3, because we have different percentage. So we have to calculate weighted average. What does it mean, weighted average? 50% multiply 19% equal 9.5. 16.7% multiply 16% equal 2.7%. 33.3 multiply 12% equal 4%. Summation equal 16.2%, which is approximately 16%. So the cost of capital is 16%. Now, you have the same information as exactly the previous lecture. Now, you have the initial investment, which is 600,000, and you have the cash flow, which is 170, it is mentioned, 175,000 for how long? For 5 years. Okay. This is a case of annuity. And now you have the cost of capital, which is weighted average cost of capital is 16%. Now, we need to calculate the net present value. NPV, net present value, remember that NPV equal the present value of the cash flow minus the initial investment. Present value of the cash flow, this is annuity, equal the cash flow multiplied by the factor. I appreciate this if you still remember the equation, which is 1 minus the factor 1 divided by 1 plus r power t divided by r, all minus the initial, which equal cash flow, annuity cash flow 175,000 multiplied by 1 minus 1 divided by 1.16 power 5 divided by 0.16, all minus the initial 600,000. In this case, it will be, is calculated here, it will be 573, this value 573,000 minus the initial 600,000. It is a negative value, which equal minus 27,000. So should I accept or reject? For sure I have to reject. You can use any other criteria. If you have profitability index, instead of deduct, you have to do what? Divided. It will be less than 1, which we have to reduce. This is the subject for calculating the weighted average cost of capital. From now, in this case, I have the right on the exam to give you the initial and to give you the cash flow, but the WACC, it will not be given. Instead of giving the WACC as just one number, I will give you the previous example. So in this case, you have to start by calculating WACC and you go back to find the NPV or any other criteria. After the break, inshallah, we will learn how can we calculate the initial and how can we calculate the cash flow. In this case, you will be ready for the need for feasibility study. Because to do the feasibility study, you have to know how to calculate the initial, how to calculate the cash flow, how to calculate the WACC, and how to apply the criteria, which is NPV, profitability index, payback, and so on. Thank you.